Hello everyone, welcome back. I got a lot of really good ones for you today. Markets. Three major stock indices, so the Dow Jones, S&P 500, and NASDAQ all moved up just over 1% today. A little bit of follow through buying after a monster day yesterday following that conclusion of the Federal Reserve meeting. We'll get to that. Oil came down a little bit today, but the oil stocks did fine, so pretty flat day for energy. Silver had a pretty monster day, but in my opinion, coming off of some pretty oversold conditions. So silver around spot 19, gold hanging out around spot 1750, Bitcoin popping up over 24,000 last time I checked. I'm very bullish, and I'll get to some reasons why. Altcoins looking extremely strong today too. Earnings isn't really driving a lot of this. We are getting some mega tech earnings like out of Meta and Apple and Microsoft and things like that, Texas Instruments, but earnings are kind of taking the back seat given everything going on in the debt market with the Fed. So earnings I don't think are going to be terrible or blowout. They're not really going to play a whole lot here. However, the GDP number is, a bit of a factor, but we'll get to that, and then the Fed being the biggest factor. So Federal Reserve concluded its meeting yesterday. We came in with a 75 basis point hike. Markets loved it, which tells me the Fed probably should have done a 1% hike yesterday because the markets could have handled it. They wouldn't have gotten beat up too much, and that would have been a vote of confidence that the Federal Reserve is doing something about inflation. These less than 1% hikes to the federal funds rate just aren't doing enough against a serious inflation problem, probably 15% a year. So inflation's a big problem, and the Fed is coming at it with a pretty moderate set of solutions, like, oh, we're just going to raise 75 basis points here, and that's a lot. And the main event wasn't really the Fed raising 75 basis points yesterday that made the markets rip higher like that. I really think it was a lot of the commentary that came after when Fed Chair Powell said, well, I don't think we're going to need that many more aggressive hikes, or we have maybe one more big one, and then we're done. And the market loves that, because the markets had baked in over the last 6 months so much hawkishness and such an aggressive Federal Reserve. The market was baking in interest rate policy being like 75 basis points, 1%. Like the market really thought the Fed was going to meaningfully fight inflation. But now that the Fed has gotten the market all buttered up for 13 or 14 rate hikes going forward, and it's taking those rate hikes off the table, you're seeing the markets go back up. And so it makes sense. GDP came in negative today, but the Dow Jones and S&P 500 and NASDAQ have already, over the last 6 months, baked that in. So today's official recession, might mark the lows. Now, you do have a situation where Biden, Powell, Yellen, they're not going to lean into a microphone and say we're in a recession, not this close to an election, and not with this kind of secret bond buying, secret yield and rate suppression, yield curve control. They're not going to also be like, oh, we're in a recession, because also that will change people's behavior, and they don't want to do that. They don't want people to freak out. So they're going to say no recession, even though you're in one. You've had 2 negative quarters now, consecutive quarters of negative GDP growth. That is a recession. And you've seen the 3 major stock indices fall more than 20% off the recent highs. That is a bear market. You're checking every box. But the inflation numbers can kind of cover that up. A lot of these companies' earnings, they might show more revenue, but they're selling less goods. They're just charging way more for it, kind of trimming the fat, getting rid of things that maybe were loss leaders before, that they just can't keep around anything. Maybe departments that they thought were not very profitable but had growth prospects. Maybe a lot of those companies trim that fat. And so, yeah, you might see unemployment tick higher, and you might see supply chain issues persist, and you might see inflation persist, and you might see more small businesses go under, and just bankruptcies and loan defaults, and people getting squeezed by inflation, and the middle class just being decimated. But lo and behold, that doesn't necessarily mean asset prices collapse. If anything, I am so much more concerned about inflation than I am deflation at this point. So I'm not really looking at fundamental valuations. I'm not really looking at technicals. I'm looking at market expectations, knock-on effects of bad policy, and sentiment. And sentiment in the market now is getting quite bullish because that dollar is looking quite bearish, and the dollar's looking like the Fed is going to begin trashing it again at any minute. With less rate hikes, we're going to see more inflation, and this is bullish for risk assets, which is not by accident, because if the Fed can get away with buying bonds and driving those bond yields down and driving the dollar and interest rates down and fostering an environment of risk and bringing those mortgage rates lower so that home prices continue to inflate and keep interest rates in real terms deeply negative. I mean, if they can do all of those things, they can keep inflating these markets and then just talk about getting inflation under control, talk about rolling off their balance sheet, talk about quantitative tightening. But that's just a blunt tool of expectations they use to let air out of the tires and knock those asset prices down before ultimately under-delivering on their hawkish rhetoric and then allowing markets to reinflate. And they want to do that, right? They're serial bubble blowers. They will protect their, top 100 largest companies, or maybe the whole S&P 500 will get offered some form of protection, and everyone else will be left to wither, and those asset prices will just march higher. So it just kind of is what it is. It stinks, but it creates an environment where risk assets can go up a lot. The dollar can be very weak. And you know what's funny? The dollar's staying strong relative to a lot of other countries' currencies, but that's only because those other countries' currencies have a worse inflation problem. So as inflation gets worse and worse and worse for the entire fiat global Ponzi, it does eventually begin to affect the top of the Ponzi, the dollar empire. But I mean, if you look around at other currencies, there's nowhere to run because inflation is just worse. I mean, the European Central Bank, they're at a 0% interest rate right now. When they raised their interest rates, they were raising them from negative just to zero. So the European Central Bank, they don't even have a positive interest rate. I mean, America's interest rate is very low. It's 2.25% on the Fed funds rate, which is very low, especially against the backdrop of 15% per year inflation. But it's still higher than the ECB. So if you're an American struggling with these inflation problems and not being able to make sense of what's going on, it's because the rest of the world is struggling way harder, and there's still tremendous demand for dollars. I mean, if you look at Argentina's stock market, or you look at Turkey's stock market, or you look at Venezuela's stock market, those stock markets go straight up. And you might be like, oh, those people are getting rich. No, that's just what a currency collapse looks like. And with inflation in Argentina right now at like 56% a year, something like that, you ask the people on the street what they're doing, they're buying US dollars. Even though inflation is rough for the dollar, and the dollar in its absolute terms is being incinerated, they'll still play in the dollar game because their game is more terminal and worse. So the entire fiat global Ponzi, government issued fiat trash global Ponzi scheme, is sinking down into the mud again, harder. Looks like the Fed and the ECB aren't going to be able to deliver and follow through on a lot higher rates structurally and yields structurally higher in the bond market. Looks like we're not going to see that. And if we're not going to see that, we're going to see more inflation, higher risk asset prices, a smaller middle class, supply chain issues will persist, inflation will persist. Everybody holding any government issued currency on the planet is just being completely incinerated. Like if they're saving $10,000 and they come back a year later, it's lost 20% of its value. So to me, just my opinion, cash is not a very viable place to be in any government issued form, and neither are bonds, and neither any form of fixed income or dividends from stock. You got to go growth. You got to go Bitcoin, you got to go gold, you got to go energy. But just my opinion, I could totally be wrong, and this is not a buy or sell recommendation, but I'm telling you like where I'm at and what I'm looking at and going, what I'm into, and like my favorite things to add to a balance sheet. So I don't like the dollar. Cash is still trash. Inflation's going to get worse, and inflation's the problem. So Don't let them con you into like deflation equals bad. That has been so ingrained culturally into the American psyche. But in the case of most countries and most economic environments and most policymakers and their honesty and their morality, it's not what you get. What you get is essentially a tilt towards hyperinflation before you have a tilt towards meaningful deflation. The Great Depression in the 1930s required a gold-backed dollar and just liquidity that wasn't there in a deflationary debt spiral that you're just not going to see in a macro environment where the world can just overnight become awash in debt. So we have a very, very debt-based economic system, and that does not look like deflation, mean reversions, crashes, poor fundamentals, crashing asset prices. It doesn't look like that. It looks like a terminally weak currency, asset prices going up to a point that wages don't keep up and people start getting priced out, and the birth of a two-tier society. So if you ask, your grandparents, if you're an American, what's the scariest thing for markets and your finances that you can think of, they're probably going to tell you it'd be a crash. Like if my stock portfolio, if my 401k crashed 90%, if my home crashed 80-90%, I mean, that is just my biggest fear. But if you ask an Argentine citizen or a citizen of the Weimar Republic, or if you just ask most people in other countries on planet Earth, you'll find inflation to be equally as problematic as deflation. And given our policymakers and the knock-on effects of these bad policies and what they can do with interest rates and the dollar and yield curve control, I lean towards hyperinflation, and it's horrible. So if mortgage rates go lower in the next few months, which we've talked about in videos, and if interest rates go lower, and if the dollar goes lower and bond yields go lower, house price tags are going to go higher. NASDAQ's going to go higher, gold's going to go higher, energy's going to go higher, Bitcoin's going to go higher, Beanie Babies are going to go higher, fine art's going to go higher, your grandpa's pocket watch is going to go higher, the price of a gun's going to go higher, the price of a bullet's going to go higher, the price of a tank of gas is going to go higher. So that's kind of what you got. And on the flip side of that, if interest rates went higher, the dollar went higher, and bond yields went higher, all those things I just lifted off would crash in price. But, I mean, the Fed can't even deliver a 1% rate hike to cull 15% inflation. They won't even begin to fight this fire. And so don't be surprised if you see asset prices essentially crashing up. And that makes your future self pretty poor. It destroys social upward mobility, destroys price stability. But I could totally be wrong. I could totally be wrong, and I hope I am. I would love to see the Fed, Yellen, Biden advocate for savings, a stronger dollar, raising the interest rate to the point that it breaks the back of inflation, a debt detox, so to speak, so that we can have free markets, flexible prices, healthy PE ratios, healthy markets. I mean, honestly, I'm so young, we could come back from that, and that would be real growth regime after that. Those companies that would come up after that crash would be very real, sound, fundamental companies. But are we going to get that? Probably not. You're going to see the 25% of the S&P 500 that's like a zombie and requires terminally low interest rates nearly to exist, continue to live and survive off a low interest rate, low bond yield, low dollar, high inflation environment. And the Fed, push comes to shove, will not fight inflation and protect the dollar. They will protect the B system and protect the stock market. And given this, official recession that we're in, they don't even want to keep raising interest rates, okay? And so I'd expect them not to. It's about all I got for right now. Again, it could totally be wrong. I'm just telling you where I'm at. Welcome to have your own opinion. I really encourage that and thinking for yourself. And hey, leave a comment if you'd like, if you think I'm off on something. Like, subscribe, whatever. Thanks so much for your support. I hope this helps you a little bit, kind of explain where I'm at, what I'm seeing, policymakers, GDP. Look, if you're into technicals and fundamentals, like you're a technician, you like technical indicators like MACDs and Bollinger Bands and RSIs and stochastics and volume and moving averages and all these weird technical indicators, and you're a chartist, that I'm not thinking that's a good idea right now. And if you're into and if you're into fundamental analysis, so you're like kicking rocks, picking stocks, finding undervalued companies relative to their share price, like Warren Buffett style, I don't recommend that either. I recommend following the policymakers, knock-on effects of bad policy, sentiment, and then understanding what market expectations are versus what they're actually getting, and kind of trading and investing around that. But hey, could totally be wrong. And don't completely ignore technical and fundamentals, all right? I'm just saying there's not a whole lot there. You kind of got to spread yourself around, play the game. The real thing is just being a market guy and playing the game all the time, all right? And understanding where you were, how you got here, and where you're going. And you kind of put all that together. Start with the macro. You can find out how the debt market's affecting different risk assets. And then once you've honed in on certain asset classes that specifically look good to you, then you can whittle further and find of those the best one. And now you're trying to seek alpha. But markets are tricky. Up is down, down is up. Other players at the table don't want to see you win. They want to take your chips. It's not a zero-sum game because the Fed's always pouring money in from the outside, but it almost is. So when you make $1, someone lost $1. When you lose $1, someone made $1. With the caveat that the Fed's always pouring more money in from the outside. Hang in there. Watch out for inflation, the most insidious tax of them all. We'll be okay. Till next time.